What if everything you've been told about retirement saving is just wrong? I'm talking about the age-old advice to save X amount by age 55. We hear it all the time. By 55, you need 7x your salary saved. But what if that number is a complete myth, based on outdated assumptions from decades ago? Think about it. In 1996, Beth Kobliner's book Get a Financial Life told us one set of rules. Fast forward to 2026, and those rules feel like they're from another planet. Pete Matthew, over on the Meaningful Money podcast, is still answering questions about pensions and insurance, but the investing landscape has shifted dramatically. So, does reaching 55 still mean you need that exact multiple of your salary? We're going to dig into the actual historical data, look at some real-world case studies, not just theoretical models, and see why the number you actually need might be much lower, or much, much higher, depending on one critical factor that no one talks about. 55. It's that age where retirement often feels less like a distant dream and more like a rapidly approaching reality. Maybe you're tracking your 401k balance daily, or perhaps you're just starting to really dig into what those golden years could look like. Here's a thought from personal finance author Beth Kobliner, whose book Get a Financial Life first dropped in 1996. She says the core financial tips from 3 decades ago are still working. That's a powerful idea when you're navigating today's market. Consider this. In 2022, when the Federal Reserve, led by Jerome Powell, aggressively hiked interest rates, many folks saw their portfolios take a hit. For someone at 55, seeing a 15 to 20% drop in a single year can feel pretty terrifying. But what if there's a different way to think about that volatility? What if understanding the why behind those moves helps you pivot and make smarter decisions? Today, we're going to dive into what it means to be 55 in today's financial landscape. We'll explore historical trends, talk about how market events, like the 2008 GFC or the 2020 COVID crash, have shaped approaches to retirement savings, and discuss the strategies some of the world's most successful investors, like Warren Buffett and Ray Dalio, have used to navigate similar periods. The goal here isn't to tell you what to do, but to empower you with the knowledge to make informed choices for your situation. She says the core principles of personal finance are timeless. And you know what? 30 years later, she's still saying it. In an article published on May 6, 2026, Beth Kobliner, the very same Beth Kobliner who penned Get a Financial Life in '96, affirmed that the core financial tips from her seminal book are still highly effective today. She emphasizes that things like diligent budgeting, consistent saving, and strategic long-term investing haven't fundamentally changed, despite all the technological advancements and the advent of fintech platforms. This isn't some retro fad, it's about foundational principles that withstand market shifts and economic cycles. Thomas J. Brock, a respected CFA and CPA writing for Investopedia, breaks personal finance down into 5 core areas: income, spending, savings, investing, and protection. Think about it. Whether you're a recent graduate at 25 navigating student loan debt or a mid-career professional at 55 preparing for retirement, understanding where your money comes from, where it goes, how much you consistently set aside, how you strategically grow it, and how you safeguard your assets, those tenets remain constant and universally applicable. For instance, in 1996, someone building a retirement portfolio might have invested in a diversified mutual fund, perhaps a low-cost option like Vanguard's Total Stock Market Index Fund, VTSAX. Today, someone in a similar situation might opt for an exchange-traded fund, ETF, such as the S&P 500 Tracking SPDR S&P 500 ETF, SPY, or iShares Core S&P 500, IVV. The wrapper changes, the access points evolve, but the underlying principle of broad market exposure for long-term capital appreciation and wealth accumulation? That stays precisely the same. The lesson here is that while the tools, interfaces, and specific investment vehicles evolve with innovation, the basic building blocks for a strong and secure financial future, especially as you approach retirement, haven't budged an inch. And this unwavering consistency matters significantly, particularly when we consider the Federal Reserve's influence on the broader economic landscape. Diligent budgeting, consistent saving, and smart investing are still the pillars of financial success. And she's right, these evergreen strategies remain critical. But what about the bigger picture? The economic landscape we're navigating today is shaped by forces far beyond our individual budgets. Let's talk about the elephant in the room: the Federal Reserve. On April 29, 2026, the U.S. Federal Reserve maintained its policy interest rate steady at a range of 3.50% to 3.75%. This decision, largely anticipated, isn't just some abstract number on a news ticker, it's the effective federal funds rate, and it acts as a critical benchmark that influences everything from the interest you earn on your savings account to your mortgage rates and any other borrowing costs. For those of us nearing or in retirement, this stable rate environment, or the potential for a future cut, as one voter favored a 0.25% reduction, has significant implications. Consider someone like Don, who's 55 and has a substantial portion of his retirement portfolio in fixed income, like bonds. A stable rate means his existing bond yields remain consistent, which provides some predictability. But if rates eventually fall, as that one Fed voter signaled, new bond purchases or reinvestments would likely offer lower returns. Or take Lena, also 55, who might be considering refinancing her mortgage to free up cash flow. A 3.50% to 3.75% federal funds rate, while down from the highs of a few years ago, still impacts what she'd be offered. The lesson here is that while your personal financial habits are crucial, understanding the Fed's stance provides essential context for optimizing your portfolio and managing debt as you approach retirement. This brings us to a concrete example. Reserve Board, under Chairman Jerome Powell, decided to hold the federal funds rate steady at a target range of 5.25% to 5.50%. This impacts borrowing costs for everything from mortgages to business loans, and understanding its implications is crucial as you approach retirement. For someone like Don Smith, a 46-year-old aiming to retire at 55, this economic environment creates both challenges and opportunities. Don's goal is ambitious: to achieve financial independence in just 8.5 years. He and his wife, Sue Smith, who has been a stay-at-home mom for 2 decades, are navigating the common financial pressures of raising 2 college-aged children, a senior and a freshman. This isn't just a race against time, it's a strategic sprint. Mark Whitaker, in his article How to Retire at 60, outlines similar concerns for couples targeting early retirement, emphasizing the need for robust planning. For Don, this means a multi-pronged approach. He'd likely need to aggressively optimize his investment portfolio, perhaps by shifting a portion towards growth-oriented assets, while still maintaining a diversified strategy to manage risk. It would also involve a relentless focus on increasing savings, potentially maximizing contributions to tax-advantaged accounts like a 401k or IRA, and exploring ways to boost income. Managing those college costs simultaneously is another puzzle piece. For example, by contributing to 529 plans early on, some of the tuition burden can be eased, but even then, careful budgeting is essential. The urgency required to hit a retirement goal in less than a decade often means making adjustments to spending habits, or exploring additional income streams. The lesson here is that an explicit, short-term retirement goal demands immediate and focused financial action. This level of focus is what sets someone like Don Smith apart, as he navigates his journey to financial independence. Now, speaking of unique journeys, let's look at Jock's journey to FIRRE by 55, from an expat perspective. Opportunities. It's a prime example of why understanding the macro environment is so critical. But what if you're not just dealing with the Fed, but also international borders? Let's talk about Jock, a Scottish expat whose journey to financial independence, retire relatively early, or FIRRE, by age 55 is a fantastic case study in complex financial planning. Jock turned 40 back in 2018, so he's looking at about a 15-year runway to hit his FIRRE goals. He's married with 2 young kids, currently living in Qatar, and get this, they're planning a relocation to Australia within the next 12 months. Talk about moving parts. His core strategy relies on his substantial salary as his primary income source, but he's also a big believer in the power of reinvested stock dividends to compound his wealth. Now, pursuing FIRRE as an expat introduces a whole new layer of complexity. Jock has to navigate the intricacies of international finances, which means understanding things like currency exchange rates between the Qatari riyal and the Australian dollar, not to mention the British pound for any potential future repatriation. Then there are the tax implications. Managing his tax residency in Qatar, anticipating Australian tax laws once he moves, and potentially dealing with UK tax obligations on any income or assets held there. It's not as simple as investing in a US domiciled S&P 500 ETF and calling it a day. For someone in Jock's situation, adapting to new economic environments, like the Australian housing market or local investment regulations, is paramount. The lesson here is that geographical mobility, while offering career opportunities, demands incredibly diligent and informed financial management. So, how might someone start mapping their path to financial freedom by 55? Was already deep into his FIRRE planning. The lesson here is that an international career adds layers of complexity, requiring strategic navigation of tax laws and currency fluctuations. So, how do we synthesize all of this into a clear path to financial freedom by 55? Beth Kobliner, whose timeless advice from Get a Financial Life still resonates, emphasizes the core areas: income, spending, savings, investing, and protection. These aren't just abstract concepts, they're the bedrock of what Jim Soucy, in his February 13, 2026 article Your Retirement Roadmap to Financial Freedom, identifies as needing 60 to 80% of your pre-retirement income to maintain your lifestyle. Think about Don Smith, who's got 9 years to hit his 55 goal. His current income and spending habits are directly impacted by the Fed's rates. With Jerome Powell's Fed holding the federal funds rate at 5.25% to 5.50%, the cost of borrowing for any lifestyle inflation, like a new car, is higher. This environment actually pushes individuals to be more disciplined, funneling more into savings and investments where they can potentially earn a better return. This is where the FIRRE philosophy comes in handy, even if full retirement isn't the immediate goal. It's about building financial independence and flexibility. Consider Jock's situation. By 2026, with the Fed's rate at 3.50% to 3.75%, his investment strategies would be informed by a slightly different lending environment. The lesson for someone in your situation is to consistently evaluate how current interest rates affect the growth potential of your investments, especially fixed income assets, and your borrowing costs. It's about leveraging catch-up contributions if you're over 50, like those boosting 401k limits, to accelerate savings, just as farther planning suggests for early retirees. The goal isn't just a number, it's about creating enough financial cushion by 55 to have options. So, what does all of this mean as you approach 55? It means that regardless of whether you're navigating the Federal Reserve's rate decisions like Don, tackling international tax complexities like Jock, or simply applying Beth Kobliner's timeless principles of income and spending, turning 55 isn't an ending. It's an incredibly powerful moment for decisive action. It's when your past financial decisions converge with your future aspirations, and with clear, data-driven planning, you can shape a resilient and independent future. The lesson here is that understanding these dynamics allows for informed choices, transforming what might feel like a daunting deadline into an exciting springboard. Have you ever had to pivot your retirement plan due to unexpected Fed policy changes or international relocation? Share your story in the comments below. I'm really curious to hear how you adapted. And if you want more insights into navigating complex financial landscapes, make sure you hit that subscribe button, because we're constantly breaking down these real-world scenarios. If you like this deep dive, my analysis of how the 2008 GFC impacted different retirement timelines is exactly the next thing you should watch.